Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm speaking to you from New York City on this, the 17th day of July, 2018. Before I talk more about today's show, let me remind you that I am the editor of Jay Taylor's Gold, Energy, and Tech Stocks, and that you can subscribe to my letter by going to miningstocks.com, or you can call our office in New York during normal work hours, 718-457-1426, 718-457-1426. And if you go to miningstocks.com, you can also catch up with the important articles concerning all the companies that are covered in my newsletter. And there are quite a few of those names there. And whenever there's something very significant or important with respect to those companies, I make sure that the links to those articles are posted on the homepage at miningstocks.com. I want to thank each of you for listening to this show, making it one of the more popular shows in the Voice America Business Channel. I also want to invite you to keep your questions, comments, criticisms, and praises. Send them along to questionsfortaylor@gmail.com, questions4taylor@gmail.com. We do want to thank our sponsors for making this show economically viable. Today's sponsors are RN Resources, Balmoral Resources, Bonterra Resources, Genesis Metals Corp., Klondike Gold Corp., Northern Empire Resources, and Novo Resources. I've titled today's show, Gold-Backed Bonds, an Idea Whose Time Has Come. David Jensen, Keith Weiner, I should pronounce his name correctly, and Michael Oliver return. Now, David will be with us after the first commercial break, and he will explain why Trump's anti-mainstream policies are logical in stopping trade deficits and the exportation of manufacturing jobs from the Americans that Hillary Clinton labeled as deplorables, those folks that live in flyover country. David will be with me, as I mentioned, after the first commercial break. Keith Weiner will join me in the second half of today's show to provide serious thoughts about an inevitable monetary reset triggered by Keynesian economics that has not only destroyed capital but also forbidden currency price discovery. And he will explain why he expects a return to gold-backed bonds by state governments, perhaps starting with Nevada, which has just passed a law allowing the state to borrow using gold-backed bonds. We want to find out from Keith why the time has come for the idea of gold-backed bonds and what drives that, or what drivers are in place to make that an inevitable event in his view. But right now I'm happy to tell you that we do have Michael Oliver with me once again to help soothe our nerves on a day in which the gold markets have gotten hammered pretty hard. Thanks for joining me, Michael.
Good to be back, Jay.
Yeah, so I'm having a nervy bust here. Well, that's probably an overstatement. We've been through downturns in gold for a long time, and many years I've been at this, so it's nothing really new. But the gold markets are pretty weak today. What's your take?
My take is that a few weeks ago, mid-month, last month, we put out a report that said if it had already hit 1240, by the way, at that point, and we said it bounced to 1260, and we said if you touch 1240 again, there's going to be a mini panic. Now, so far I can't even define this as a mini panic because we dropped all of $14 or 1% below the 1240 level. But in the process, you finally took out a prominent prior price low. That was December low of last year, which was in the 1230s. So this entire decline, which is now in its 7th month since our January highs, has finally come down and nipped out a prior price low. Now, anybody drawing trend lines on price charts, and I used to do that early in my career at E.F. Hutton as a futures broker, until I learned better. Anybody can draw a trend line on a price chart. Some people don't even know how to do it properly. There are proper and improper ways to draw lines. But drawing trend lines on price charts is often a coin toss. It often creates traps because anybody can do it, and if everybody can do it, it's usually wrong, okay? As Joe Granville said. So we rely on momentum. And I put out a report about 2 hours ago to our subscribers showing the current weekly bar chart decline since early in the year and the weekly momentum, which is now on that time scale, it's an ancient decline. When you're in 6-7 months of weekly oscillator decline, that's off the page old. And then finally, this late in the trend, have nipped out a prior low. So in other words, people go screaming from the rooms because you took out a prior low. Okay, fine. That needs to happen in any bull or bear market. You cannot have a pattern of ascending, let's say in a bull market, of continually ascending higher lows. Whereas every time you have a sell-off, it stops at a higher level. If that happens, what you do is you set up a trend line, and then everybody can see it. To clean out a market, to make sure it's primed to go the other way, you almost always have to go nip out something that's conspicuous. See what happens once it happens. Do you fall apart, or is it a brief panic and then you reverse back up? I'm suspecting it's the latter because of the age of the trend. It's non-confirmed on weekly momentum and so forth. Plus, then in the same report we covered, I went back to 2000, year 2000, and I showed gold annual momentum and how it behaved from the 2000 upside breakout that lasted, a bull trend that lasted until 2008 peak. And it was a three-wave, massive annual momentum uptrend. But if you examine its internals, both in price and on the momentum chart, this is big picture stuff now, there are plenty of zigzags to the downside during that 8-year period, which you would have made a ton of money being long gold. But if you flinched at every time it went down 10% or 15%, and there were so many times that happened that it was ridiculous. And a lot of the times the price chart would break some prior low or break some stupid trend line. So all I can say is anybody who wants to flinch every time gold has hiccuped, and it's hiccuped a good couple times. In fact, the big one was in December 2016. That sell-off was quite deep, much bigger than this one. That you'll miss the move. So if there is a major up move coming in gold, which we argue there is, and we think we're only in the first leg up, and then the corrective pullback after the first leg up, before the second leg emerges, usually there's 3 major waves in any annual momentum trend, then you'll get flinched out of this market and you'll miss it. So my suggestion is to people who want to be long, be sure if you're long, you're not so leveraged that a 10 or 15% pullback here and there won't kick you out every single time, because otherwise you're going to miss it.
Sure.
So be sure your position is fitting to your personal capabilities.
Yeah, exactly. Yeah.
You know.
No, I hear you. You don't want to get triggered out and lose everything. Yeah.
No, I mean, there's simply no trend in the world other than a crash in 29, which was over in, weeks, and the 87 crash that is from A to Z, done in weeks. I mean, any multi-year trend has got to have counter-trend moves, either up in a bear market or down in a bull market, that are such that they scare people out. And in order to scare people out, you usually have to go down and take something out that they say, oh, my God, it took out a low. And so everybody runs. And we just took out the December pivotal low, which is not all that pivotal. It's just a conspicuous low on a chart. So if somebody was long saying, I'm going to run if it takes that out, well, they're gone. Now, maybe they're right. I don't think they are. I think they'll probably not get back in. And that's the real problem, is if you exit every time something like that happens, all you have to do is fail to get back in one time, and you've missed it.
So we're near the low. We've taken out those lows, and you think we're primed for something better on the upside?
If they want to go down and hit 1,200, there's some point-and-figure people out there keeping 50-point by 3-block reversal point-and-figure charts. Will get pretty excited about the upside, because what you'll have then done is set up a double top at 1,350. If you touch 1,200, by the way. If you turn back up to 1,350, it's a triple top breakout waiting. So, on a big scale price chart basis, some people see this pullback as potentially bullish. I don't know if you'll get to 1,200. But you at least took out the December low of last year, which is a prior conspicuous low. But it took you 7 months to get down to that low, which is an arduous process. And, I don't know that the clock, which is a technical factor, time is a technical factor, not just lines on a chart. And to spend 7 months of trying to arm wrestle your way down to take out some prior low is kind of exhaustive. So we'll see. But we're still bullish on annual momentum, and this looks very much like the period of 2003 through 2005. And what followed that period of time was a massive bolt on the upside.
Boy, was it ever. Well, Michael, it's just about a minute left here yet. Do we need to see, the equity market it seems like it's never going to correct, although when I look at your structure momentum charts, certainly you can see it's breaking down. But do we need to see a real significant decline in the equities before people start getting excited about gold, perhaps?
That will help. There's no doubt that will help commodity assets, particularly gold, in that if you shake people out of that category, they'll go look somewhere else. And frankly, the bond market doesn't look too good. So you're pretty much left with, well, let's buy some cheap commodities. Particularly the food commodities that haven't had their recovery yet, unlike copper and oil, which are, by the way, are breaking down, which should not be interpreted well by the stock bulls. Those are the two commodities that tend to link to economic trends and to the stock market.
And the stock market.
Gold, grains, and sugar and so forth don't, but those do, and they're breaking down.
All right, Michael. Well, we'll have to let it go at that. I thank you so much for your lengthy explanation on the gold charts. Very important to us today, in a day in which the gold markets are getting hit pretty hard. Not that hard, as you put it into perspective, but nonetheless, for those of us that are on the long side, not a pleasant experience. But thanks for helping us out with that. Really appreciate it.
Thank you, Jay.